Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we'll explore the risks involved, the fees to be aware of, and how to get started with hedge fund investing. Let's dive right in. Market and liquidity risks. Hedge funds aim to beat markets, but they're not immune to downturns. Many strategies backfire when markets move unexpectedly. Leverage amplifies losses. Borrowing to invest can turn small drops into wipeouts. Short-selling risks. If a shorted stock rallies, losses are theoretically unlimited. Macro missteps. Global funds betting on interest rates or currencies can be wrong for years before recovering. Liquidity is another hurdle. Most hedge funds lock up money for months or years, need cash during a gate period. You might wait or face steep withdrawal penalties. Even funds that allow quarterly redemptions can suspend them if too many investors rush for the exit. High fees and hidden costs. The 2 and 20 fee model eats into returns. Over a decade, fees can claim over half your gains. Here's how. Management fees, 2%, paid yearly, even if the fund loses money. Performance fees, 20%, skimmed from profits, often with no high watermark to prevent double charging after losses. Fund expenses. Trading costs, legal fees, and other charges often get passed to investors. Example. A $1 investment earns 8% yearly before fees. After 10 years, fees take $486K, leaving you with less than the S&P 500's average return. Operational risks. Behind the scenes, hedge funds face risks like key person dependency. Many rely on a star manager. If they leave, performance can collapse. Fraud. A lack of oversight makes Ponzi schemes like Bernie Madoff's possible. Tech failures. A trading algorithm glitch can wipe out millions in minutes. Investors must vet funds thoroughly, looking beyond returns to ops, audits, and backup plans. Hedge funds demand patience, deep pockets, and a stomach for uncertainty. The rewards can be real, but so are the pitfalls. Who should invest in hedge funds? Hedge funds aren't for everyone. They cater to investors who can handle high risk, tie up money for years, and stomach market swings. Before jumping in, you need to know if your financial profile matches what hedge funds demand. Institutional versus individual investors. Hedge funds serve two main groups, institutions and wealthy individuals. Each has different needs, and hedge funds meet them in unique ways. Institutional investors. These include pension funds, university endowments, and insurance companies. For them, hedge funds offer diversification. Institutions use hedge funds to spread risk beyond stocks and bonds. Lower volatility. Some hedge funds smooth returns, helping institutions meet long-term obligations. Access to niche markets. They can invest in strategies like distressed debt or private equity deals, but challenges exist. High fees can drag down returns, especially if the fund underperforms. Limited transparency makes it tough to track risk exposure. High net worth individuals. Wealthy individuals often chase higher returns than traditional investments provide. For them, hedge funds can offer exclusivity. Many top funds only accept investors with 1M+ to invest, provide tax advantages. Some hedge funds structure gains as long-term capital gains, deliver uncorrelated returns. Hedge funds might zig when markets zag, adding balance. However, the downsides are real. Lack of liquidity. Many funds lock up money for 1 to 3 years. Concentrated risk. If a single bet goes wrong, losses can be steep. For both groups, due diligence is key. Investors must research strategies, fees, and track records before committing. Those who do their homework stand the best chance of success. How to evaluate and select a hedge fund. Choosing the right hedge fund takes more than just looking at past returns. You need to dig into the strategy, fees, and the manager's track record. If you skip the homework, you could end up with surprises down the road, like hidden fees or unexpected risks. Questions to ask before investing. Before committing capital, get clear answers from the hedge fund manager. These questions help you understand what you're really buying into. Fee structure. How does the 2 and 20 model apply? Are there high watermarks to prevent double charging on past losses, or hurdle rates, minimum returns before fees kick in? Redemption terms. Can you withdraw money quarterly, or is there a multi-year lockup? Are there penalties for early withdrawals? Risk management. What safeguards are in place if markets turn against the fund's strategy? How often do they stress test positions? Investment strategy. Is the approach consistent, or does the manager frequently pivot? Can they explain it simply? Team stability. Has the key portfolio manager stayed for at least one full market cycle, bull and bear markets? Transparency. How often do they report holdings and performance? Do they allow third-party audits? If a manager dodges these questions, that's a red flag. The best funds welcome scrutiny because they have nothing to hide. Analyzing historical performance. Past performance doesn't guarantee future results, but it reveals patterns worth watching. Consistency over time. Look for returns across bull and bear markets. A fund that only shines in good times may not survive downturns. Drawdowns. How steep were losses in bad years? A fund that drops 30% needs a 43% gain just to break even. Peer comparison. Check how the fund stacks up against similar strategies. Winning in isolation doesn't mean much if competitors did better with lower risk. Focus on risk-adjusted returns, not just raw numbers. A Sharpe ratio above 1 suggests the manager rewarded investors for the risks taken. Manager track record matters. A manager's experience often predicts future behavior. Look for tenure. Have they managed money through at least one full market cycle, 7+ years? Alignment of interests. Do they have their own money in the fund? Skin in the game reduces reckless bets. Reputation. Check for regulatory fines or lawsuits. A quick SEC search can reveal past troubles. Managers who've navigated multiple crises tend to handle turbulence better. If they've only seen good times, proceed with caution. Strategy goal alignment. Not all hedge funds fit all investors. Ask yourself, does the strategy match your risk tolerance? A volatile macro fund might overwhelm someone seeking steady returns. Is the liquidity policy realistic for your needs? If you might need cash soon, avoid funds with multi-year locks. Do fees leave room for profit? After fees, some funds barely outperform an index fund. The best hedge funds complement your broader portfolio. If you already have high-risk investments, adding another aggressive fund might not be wise. Take your time, verify claims, and never rush into a hedge fund decision. The extra effort could save you from costly mistakes. This video can deliver strong returns but come with higher risks and fees than traditional investments. They work best for accredited investors who can handle volatility and multi-year lockups. Success depends on strategy fit, manager skill, and rigorous due diligence. Before investing, compare fees, review performance across market cycles, and ensure liquidity terms match your needs. Not all hedge funds outpace the market, so vet them thoroughly. If in doubt, consult a financial advisor who understands alternative investments. Ready to dig deeper? Explore funds with clear strategies and transparent track records. Your portfolio and peace of mind will thank you. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.